right. Welcome to the show, everybody.
All right, here we go.
Everybody.
Dude, it's too bad they couldn't have been in on that Bitcoin conversation we just had.
I know we just had a nice 30-minute figuring out all the problems of the world of Bitcoin. Really what we're talking about is the differences of how you kind of come at it, which I think is very interesting. It matters what you're trying to get out of it. And that's that way with any asset, any investment period, right? It's why it makes it so difficult, because I think that I was thinking about this as we were getting ready to start the show, and it's kind of applicable, I think, to people that watch this, hopefully it will make sense. But, when all you guys and gals out there are watching analysts, maybe even watching people like us, right? You always have to put it in context of what they're talking about, what their come from is. Are they talking about being a retail investor who works with an advisor? Are they talking about someone who's doing all their own stuff on Robinhood? Or are they talking about an institution? You really have to get, because sometimes they'll just flip back and forth all around, and you don't catch the nuances of what they're explaining, because they're talking heads and they've got 30 seconds to get a point out. Yeah. And so and context matters, right? And usually the stuff that we all see on TV is not relatable to the thrift savings plan.
Yeah, most of the time, no.
That's why I like what we do, and I know I'm patting myself on the back, but I mean, I think if there's one thing that you all that are watching this realize is that our context is 100% the TSP. And we did this for that very reason, because we couldn't go anywhere and find that. Right. And so we're I remember being very pesky about this to Jerry. I'm like, we got to do a podcast. We got to do a podcast. And we started it during COVID, and we didn't have any equipment, and it was awful in my basement. Yeah. And but I was just thinking, we have to do this, because this is something you can't find anywhere. You might find one video or two videos with somebody, but not every week. Right. And so that's our context. That's where we come from, and hopefully that's why you're watching.
Yeah. It makes a big difference if you're, most of the time, as you've said before, the talking heads don't talk about tax-deferred accounts. Every once in a while, they'll focus on that specifically, and then at least you know what the conversation's about. But, the difference between how you might or might accumulate Bitcoin, for example, in a cold wallet, or if you're trying to buy actual Bitcoin, that obviously has nothing to do with TSP. It has nothing to do with a tax-deferred account. And that's, like we were talking about earlier, maybe one of the reasons why the last big run-up in Bitcoin happened as ETFs started coming online, because it gave people an opportunity to buy it as passive, as you can do it in the mutual fund window. You can put some percentage of your paycheck every week, whether Bitcoin's going up and down or not. You're contributing passively to Bitcoin.
What's the mutual fund?
BTCFX.
Oh, yeah.
It's the ticker symbol for Bitcoin. And how you would trade it. So, because what we were talking about before is, you don't trade it, right? You buy, if you're putting Bitcoin in a cold wallet and you're buying it $100 a month, you're keeping it. You're not selling it. You're not trading it. You don't care what the price of Bitcoin does, because you're just accumulating Bitcoin. It's how most people accumulate gold. But if you're in a tax-deferred account, and you don't have to worry about paying taxes on the sale of Bitcoin, and you're using let's say you have it in the TSP in the mutual fund window. If you get another 500% pop in Bitcoin, let's say, and you had some amount in there in the mutual fund window, your total value of your TSP just went up a lot. And if that's the money you're using to live on in retirement, you've just upped your standard of living in retirement. That's a completely different come from than accumulating Bitcoin over time to not sell and hand it down to your kids and all those kinds of things. So you just have to know what your goals are and what your plan is.
Yeah, that's the biggest thing. I mean, that's really what it comes down to. And a lot of time people don't think about, why am I investing in this particular thing in the first place? Yeah. Right? You do have to treat your retirement account very different for a bunch of reasons. You have to treat it differently than you would, these outside things. I started buying Bitcoin because I'm a tech nerd, right? And I love the idea of the blockchain and all these crazy things. And it was just interesting. And then that started to change when it really started to become a kind of more mainstream thing, a little more regulated, a little more trusted, all these things. This is what we were just talking about in the conversation before we came on. And that got me to thinking differently about it as an investment. Yep. If you believe right? That the probability is that it's going to reach certain numbers, say $500,000 for a Bitcoin, and right now we're at like 96,000, right? So that's a lot. Who knows how long that's going to take? But if you believe in that, based on the fact that the scarcity of it increases, right? There's less of it. That's kind of the rules of Bitcoin. If you have to believe in all of that, then you're like, okay, I'll just buy a little at a time, regardless of what the price is. And this was the key thing that Jerry and I were talking about. If you're doing it the way I'm explaining it, it has to be money you don't need. It's not your retirement money,
Right.
It's money you absolutely don't need. You just say, oh, I didn't buy Starbucks this month. I'm going to put it in Bitcoin. Like, do not go out and put a lot of money that you might need in something like that. That is irresponsible.
Yeah, for sure.
Anyway, well, let's talk about the show.
Something else. All right, what do we got? So another volatile week. We'll go through the normal economic stuff, but the big three really were DeepSeek. It came out on Monday. Tech earnings, there were some big companies that earnings came out on Wednesday and Thursday, and then the Fed meeting was on Wednesday. Not too much really happened there, but and then we got a couple of charts that I think are pretty important. So we'll talk about that when we get there, and then the TSP fund charts. So Monday we get the Dallas Fed Manufacturing Index is up 14.1 versus 3.4 from last week. Manufacturing definitely headed in the right direction. So this is what I was debating on whether to do, a 10-year, 3-year, or 1-year chart to put up. But what you can kind of see the flow of the economy, at least in terms of manufacturing, and how that tends to follow the price of the S&P, right? The S&P is going up. 2018 was a really rocky year going right into the end of the year, and manufacturing is coming down. Right? 2019, manufacturing did not get the run up that the S&P did, but then obviously when the economy closed, manufacturing went way down. It had the big rally into 21, came down into 22. So you can see that manufacturing kind of is a pretty good proxy for the S&P overall. And where we are right now is certainly trending up. Right, we've broken out of this channel, and we're definitely trending up, so we're going in the right direction. S&P was down on Monday 1.41%. That obviously had nothing to do with the manufacturing data that came out. Tuesday, Case-Shiller Home Price Index year over year is up 4.3 versus 4.2 last month. So home prices still moving higher nationally. It depends where you are in the South. Florida is getting kind of hammered. There are certain parts of the country that are getting hammered, but the Northeast is still doing pretty well. But on a national basis, it's ticked up a little bit, which is a potential sign of sticky inflation, because the housing component of inflation is like 40%. So if housing, they use what's it called? It's a rent number that they use. It's not really housing prices, but definitely sticky inflation. Wednesday, mortgage rates come out again. They stay steady. They were at 7.02% last week. They're at 7.02% this week, but applications came down 2%. So it's been kind of erratic the last couple of weeks in at least the mortgage market. And then Wednesday was the Fed announcement and the press conference. Not a whole lot. Everybody expected the Fed to keep rates where they are, even though the president came out a couple days earlier and demanded that rates around the world come down. But Fed kept rates where they are, and it didn't have too much of an effect on the market. The S&P was down almost 0.5% on Wednesday. Thursday, initial jobless claims come out, 207,000 versus 223,000 last week, and the forecast was for 228,000. So again, and continuous claims were down. So between the manufacturing index going in the right direction and jobless claims going in the right direction, the economy seems like it's doing pretty good. And then Friday, we're going to get core PCE, personal income, and personal spending, and we'll see. It hasn't really had much of an effect, at least as of an hour ago or so. The market was up like 0.5%. It's pushing up against all-time highs. That's really the thing we'll look at it on a chart. So Monday, DeepSeek. So DeepSeek is a Chinese AI company that specializes in development of open source large language models, right? LLMs. So in January 25, DeepSeek released its chatbot application. DeepSeek R1 quickly became the most downloaded free app in the App Store, surpassing ChatGPT. So this achievement was particularly notable given DeepSeek's developed its AI model at a significantly lower cost. This is the thing that put the market, at least the tech sector, in a tailspin. If they can create this AI model for $6 million versus $100 million reportedly spent on OpenAI's ChatGPT-4, right? So obviously that's a problem for NVIDIA, which we'll get to, and Microsoft and some other companies. Apple actually benefited from this. Additionally, DeepSeek's model requires only a tenth of the computing power compared to other LLMs. So if all that is true, again, it's a Chinese company. Everybody kind of looks at it a little bit skeptically, but if it's true, it's potentially a game changer, and we'll see along the way. Company success has had a substantial impact on the tech sector. It led to that sell-off. DeepSeek's approach to AI development emphasizes open source principles, making its generative AI algorithms and training details freely available for use modification. I mean, we'll see what the restrictions are. I know the Navy already came out and said you can't use DeepSeek. If the government comes out and says, well, it's great that it has overtaken ChatGPT-4 in the App Store. If the government comes out and says you can't use it, then that'll put the kibosh on it pretty quick. All right, so we'll see what happens with DeepSeek. Then we had tech earnings. So tech earnings were actually pretty good. I tried to find a chart that Lance Roberts did a couple of weeks ago, and I couldn't find it, but he always talks about the everybody's a winner. What's that called? I can't remember. Like, basically, it was a chart of earnings expectations. Everything seems to revolve around, if you beat the earnings expectations, that's like what's important, right? Well, if you say, okay, and just look at it, earnings season to earnings season, and you keep beating expectations, that's great. The stock price keeps going up. But if you pull back and chart the earnings expectations themselves, the chart goes like straight down. So basically, the earnings expectations keep going down so that the companies can beat expectations so that the price of the stock keeps going up. It's hysterical. When he talks about it, it's really funny. He's like, he calls it like that, you're all a winner, everybody gets a trophy or something like that. Because if all you have to do is have the expectation low enough that you can get over it, and that's what the market cares about, then that's great.
Yeah, the only thing you can keep that can keep that from happening is, enough credible analysts come out and say those estimated earnings are BS. Because I've seen that happen, and then the company gets like, okay, well, let's revise our earnings. Yeah. So it definitely is a dance. It's a dance, because that is what drives a lot of it is earnings, which is crazy, but I mean, it's the fundamentals of the company.
That's what it is. So Meta has a pretty big upside surprise. It was up 18.7% over what they expected, and then Meta was up Wednesday and Thursday. Strangely, Meta, if you looked at a chart of it on Monday, spiked down, but then came all the way back up. And they're big in AI, and so I was kind of surprised that they didn't tank like everybody else, but they're up Wednesday and Thursday. Microsoft, upside surprise, almost 4%. Microsoft was down big Wednesday and Thursday. Apple, upside surprise, down Thursday, but it gapped up big this morning, so we'll see how Apple closes on Friday. And then Tesla, downside surprise, which is interesting. So they missed expectations by 5.73%, down on Wednesday, up on Thursday. So a little bit of a mixed bag, and we will see. But these are the companies that drive the S&P. Fed meeting. There's nothing there because there's nothing to talk about. It was I wasted an hour and a half of my time watching Powell, and the market didn't even move. It was one of those recently kind of rare Fed meetings where the market doesn't do something significant. So nothing really happened.
I mean, you didn't really see anything significant, though, right?
No, they tried really hard to get him to talk about, what happens if we slap 25% tariffs on Canada and Mexico and this and that, and is inflation going to do this? And
he stayed away from
he would not go anywhere near anything about Trump whatsoever.
Yeah, yeah. It was pretty bland for the, as opposed to what it's normally been like. Yeah.
Yeah. So nothing really to report there, but we did have a Fed meeting.
I mean, if you remember, like we've been doing this show for almost 3 years, and there were times that like that wasn't even remotely something to talk about, right? The Fed meeting.
Yeah, no, it never used to be.
Right.
I mean, nobody
cared.
Used to know who the Fed chairman was.
Yeah,
and hopefully you guys out there don't really care who the Fed chairman is either. But if you got to do it for a day job, there it is. All right, this is probably the most important chart. I would hang this one in. Well, you don't really need to hang it on your refrigerator because it's pretty timely at this point. But there's an idea in technical analysis of AB equals CD. So here we are at point A at the bottom from COVID. This is a weekly chart of the S&P 500. Okay. So the length of this line of AB is the same as the length of this line CD. And that is exactly where we are right now. Okay. And we hit resistance there. That was the high from December. We pulled back. We're making another run at it, and we'll see if we can break through it. Okay. So we should expect some resistance at the ABCD level. It's a target for resistance. It doesn't mean the market's going to roll over there. It's just a target for resistance, and obviously it hit it, and it's churning. It's trying to decide if it's going to break to the upside or the downside. The other thing on here, divergence, we talk about all the time. So here's price coming into the top in 2022, the end of 2021. And the relative strength peaked on that high in October, November of 21. November, I think it was. As price continued higher, the relative strength continued lower until it broke down. One of my favorite indicators is this orange line. It's the moving average of the relative strength index. And so if you got a peak here, a lower high here, as price is still climbing, that's bearish divergence, it's called, because the strength of the underlying move is weakening. Okay. And then that led us into the bear market in 2022. And so where we are right now, we have a double top, right? But we have a pretty decent decline in relative strength. So it just means that the strength of this rally going into that top, right, is less than the strength of the rally going into the same number top. So does it mean that we're going to get this in 25? No, it doesn't. But you're at the ABCD target. You have the momentum behind the move waning. So you take that into your analytical calculus if you're trying to decide if you want to stay in the stock funds or you've made some gains and you want to reallocate to the G fund, and then see what happens. If it breaks through, say, 6250, let's just say on this chart, you're high enough above there that it's likely to keep going, and if it does pull back, it should find support at that level. So it's a decision point is where we are right now. The bias is to the upside because we're in a bull market, right? We've been in this bull market, so the bias is certainly that it keeps going higher. But it's a good target, and we're right on it. This is one from Lance Roberts. It's a little bit old at this point, but still not too bad because this is probably where we are more or less right here. What happens going back from 1932 to 2020? They did typical post-election resistance. Okay, so on average from 1932 to 2020. You have some resistance after the election. You had an initial run up after inauguration, and then the market starts to kind of fall off a little bit. So that's sort of in line with what we would expect maybe here on this chart, especially since we're hitting resistance at those levels. Don't know, but it's something else to throw into your risk-reward scenario. Okay, TSP fund charts. So this is a weekly chart of the C fund. This is the 20-week moving average line and relative strength, right? So ever since we got above, really the 50 line on relative strength is really something to kind of keep an eye on. Whenever relative strength is down here below 50, that's when price is going down. When relative strength is above 50, you're good. Price is going up. It's pretty much as simple as that. When it gets to the 50 line, either it's going to bounce off the 50 line and keep going higher, or it's going to break down through the 50 line, and that's the beginning of your bear market. I mean, until RSI gets down here below 50 on a weekly chart, right? And when it does, you're going to see it below that 20-week moving average line. But until then, the trend is up. S fund, a whole lot more volatile, but we definitely got support a couple weeks ago at that 20-week moving average line and right there at the 50 line. So same kind of thing for the S fund. As long as when price is below that line, the market's going down. When it's above that line, the market's going up. It doesn't have to be any more complicated than that. iFund has not been doing great, and I don't have a chart on this, but I think I do. Oh, you know what? I did it for the member webinar. That's what I did it for. Interesting, right here in September, and you see it on the iFund and the F fund, because in the iFund, when the dollar goes down, the iFund goes up. And so when the Fed started cutting rates in September, the dollar started moving up and the iFund started moving down. And so we are a little bit below that 50 RSI line. I mean, we're back above it at 52 as of right now. But the big question is, we're at a decision point. Is if RSI keeps moving higher and price keeps moving higher, great. The iFund is good. The dollar will be coming down because of that, or vice versa. Dollar will come down, which will cause that. But as of right now, it's not the close yet on Friday, but we're above that 20-week and we're above 50 on RSI. So iFund is definitely a potential buy at this point. That was the F fund. Sorry. That was the F fund. It's going to be the same looking chart as the I fund. I must have messed up the order. Nope, there's the I fund. I don't know how I did that. All right, here's the I fund. Kind of similar. So that peak in September, and the same thing, except with the F fund, it's yield. With the I fund, it's the dollar. So once the Fed started cutting rates, yield started going up, which pushed the F fund down. The dollar started going up, which pushed the I fund down. But yeah, the I fund back above that 20-week and back above 50 RSI. So very similar to the F fund, because the dollar and yield tend to work in tandem. That was the F fund, and the G fund keeps going up and to the right. So if you're in the G fund, you may be looking at some of these stock funds that you're like, man, I could have been, but you're at the top of a target for the S&P 500, and you're certainly not losing any money. Now, you're not getting the gains that we had from last week when the market was at its low point or whatever, but you're generally we've been at that target since the high in December. So anything that's kind of happening there is churn, and hopefully we break through that target level. We shall see. Questions?
Yeah, it's just like we were talking about yesterday with the idea of this idea, if I'm in the G fund, I'm not performing well if something else is, and that's just not the case, because the G fund gives you a return, right? It has a positive return no matter what. All of my money sitting in a money market account or whatever, in my IRA or whatever, somewhere else, that's not getting anything. It's literally going flat, right?
Yeah.
The G fund at least goes up.
It's
and to
4%,
the right.
4 to 5% rate of return
Sometimes
for the
that's
year
fine.
with no risk. It's pretty
With
good.
no risk. That's the key. Everybody's got to remember that. We get so many people still that for some reason can't wrap their head around why it's not a bad idea sometimes to be in the G fund. And like, you should never be in the G fund. I just can't grasp why they can't grasp that simple concept that, you know what, if the risk is high of it turning around on you, at least you can go to the G fund and still keep moving your balance up. My performance is not equal to the market's performance. My performance is the account balance and my TSP.
The thing is risk. The thing that people, I think, don't get their arms around is risk. So like that chart, that S&P target chart is a great example. The risk right there is pretty high because we know the market's way overvalued. We have all these, things going on in the world, and we're at this target. So if you look at that and you go, okay, I'm going to take something off the table. You don't have to go to 100% G fund, but I'm going to take something off the table because if it rolls over here, I want to lock in the gains that I've made, right?
Yeah, the impact will be less if that happens, right? It's only 50% of your account if you go 50-50.
If it rolls over, then sell the rest of it, right? Then go to the G fund for the rest of it, whatever. If it breaks above it, you miss that gain that you would have gotten, but you avoided a whole bunch of potential risks. So if you don't factor risk into your calculations, you'll get all the gains of the C fund if you were 100% C fund, and you'll get all the losses of the C fund. So,
yeah. All right. If you guys, let's see. Questions. I'll throw the question slide up there. If you have any questions, shoot them to us in the comment section where we can find the video. If there's no comment section, email us, support@growmytsp.com, and they will get it over to us. Hope you guys are having a great weekend and hope you have a great week coming up. We will see you soon.